Alright, so this one is to show how when we buy inventory, how we book revenue when we sell that inventory we buy. So let's start. We invest $40,000 of our own money into Bite Size Corporation. So, and that's on May 1st. So we're going to start putting dates now since it's important. May 1st, we put in $40,000 of cash and we credit common stock for $40,000. Next, we buy fruits for $800 on May 15th. Now this, since we're in the fruit selling business, we're buying fruit from a wholesaler for $800 on May 15th. So May 15th, what we get is inventory of fruit for $800. Anytime we add an asset, it's always a debit. $800. And we credit, since we paid for it cash, $800. If we had paid on credit, this cash would be accounts payable, and instead of being an asset up here, it would be a liability down here. But right now, we paid cash. Then it says we sell all of the fruit for $1,300 on May 16th, which is the very next day, May 16th. Now, we sell all of the fruit. We bought $800 worth of fruit, and we sold it for $1,300. So what do we get here? We get cash for $1,300, and we're booking revenue, because revenue is also known as sales, which is how much money we made, $1,300. But we didn't really make $1,300 because we spent $800 buying it. So really, we only made the difference of $500. But we need to adjust this inventory, because if we don't adjust it and we look on our balance sheet, it's still going to be here. There's going to be inventory for $800 here. So we have to get rid of it. So to get rid of an asset, we have to credit it. So inventory, we will credit for $800, and the debit is cost of goods sold, which is an expense account. So if we put all our entries into a balance sheet or income statement, let's see where they go. First, we have the cash, $40,000, minus $800 that we spent buying the inventory, plus the $1,300 that we got when we sold the inventory. So altogether, that gives us $40,000 and $500. Then we can put in the common stock down here for $40,000. Now we have inventory of fruit, $800 debit, and then when we sell it the next day, we get rid of it, $800. So inventory is 0. We don't have any fruit left. Okay, now the last two are expense accounts. Income statement accounts. So revenue will go up here, and the cost of that revenue will go down here. Now you see, this should be 800. Now you see, this is the difference between the 1,300 and the 800. We have revenue for 1,300 and cost of revenue 800. This should be cost of revenue or cost of goods sold, same thing. 800, which gives us a total of 500. Now this 500, oops, sorry about that. I don't know what just happened. Okay, this 500 we can move it over into retained earnings. And if we check our assets, 40,500 does equal our liabilities and owner's equity, 40,500. And we did this correctly. Cool? Any questions? Let me know.